Welcome to School, and today we are going to learn the S4, and it would be in English language as most of you have demanded for the same. Okay, so let's start with AS4. AS4 is all about contingencies and events occurring after the balance sheet date. First of all, we will learn all about contingencies. Okay, so what does contingency mean? So it is an outcome that is decided or that is dependent upon the future events. So whatever is dependent upon the future events, that is known as contingencies. Okay, so what would be its accounting treatment? As we all know that there is a prudent concept. What does prudent concept say? Prudent concept says that we have to record all the future expected losses but not the gains. Okay, so this is the prudent concept. So so when we apply the prudent concept in contingencies, we will get that we don't have to recognize any contingent gains. Okay, we don't have to recognize contingent gains, but for the contingent losses we have to determine the expected outcome. Then as per the prudent concept, we have to make some provision for that. Okay, we have to make the provision for that. But if you are not able to determine the expected outcome, then what? Then you can disclose the nature and existence of that event. Okay, so this was all about contingencies. Now coming to the second part is all about events occurring after the balance sheet date. So after the balance sheet date, yes, many events occurs in business, like there may occur sales, there may occur purchases. Okay, but here in this as4 they are talking about the contingency part. Okay, so if normally any purchase is happening, any sales is happening, that would be recorded in the next financial year. Okay, next financial year only. Okay, at whatever the normal transaction business would be, it would be recorded in the next year only. But so before coming into the events occurring after the balance sheet date, I would like to tell something. Like in real life what happens is that there is financial year, like from 1st April till 31st March. Let's take an example: 1st April 2017 till 31st March 2018. Okay, this is our financial year. So the books should be made on 31st March 2018. But in actual practical life, the book doesn't get finalized on that particular date, on 31st March. Not a CA comes and do all the finalization. No, it doesn't happen like that. There are many adjustments to be done, there are many things to see and then to check. So they takes it takes many times. Okay, so it takes might be like 1 month, 2 month, or 3 month. Okay, and then after that only it gets finalized, the book gets finalized, and the board of director gets their approval on that books. Okay, this is the case of practical real life. But in the accounting terms, we all know that what we just have to record till the financial year. Okay, whatever the events is occurring of the financial year, that is from 1st April 2017 till 31st March 2018, we just have to record that much only. But when there is some contingencies, okay, there is some contingency that has the condition which has arose in that particular financial year, but the events took after the balance sheet date, but before the approval of the board of director, then it's our right or the user's right, or the users financial statement users is their right to get to know what was the contingent event that had occurred. Okay, that had occurred, they have the right to know that. So that's why that event the event that took place after the balance sheet but before the approval of board of directors, and the condition that has arose before the balance sheet, that event is known as adjusting event. Okay, so let's see. I hope you are able to see the charts. So what is simply an events occurring after the balance sheet date? So whatever the events that took place after the balance sheet date, but before the board of approval, that events are known as what? Events occurring after the balance sheet date. Mostly what? Mostly it's all about contingencies, not day to day transaction. Okay, I already told you what is adjusting event and what is non-adjusting event. Then also once again we will learn. So what is adjusting event? So adjusting event means before the balance sheet date there arose some conditions. There arose some condition that some contingency would take place. Okay, some contingency would take place. Okay, so if there was some condition before the balance sheet date and the event took place, after the balance sheet date but before the approval from board of directors, then that event is considered as adjusting event, which means that you have to adjust that event, whatever the event took place after the first 31st March 2018, whatever that event took place, we have to adjust in the previous year itself. That is, on 31st March 2018, the balance sheet was made. In that balance sheet only, we have to adjust that events. Okay, so that's why the name came adjusting events. Now, what is non-adjusting events? Let's see that. So, non-adjusting events means the condition that took place after the balance sheet, and might be the events also took place after the balance sheet. Okay, so before the balance sheet date, there was nothing. So it's an non-adjusting event. Okay, it's very simple. Now, what are the disclosures of adjusting event and what are the disclosure of the non-adjusting event? Let's see. So as we all know that we have to adjust the events in the balance sheet date only, so we have to disclose in the financial statement only. Okay, whereas on the other hand, if it is a non-adjusting event, then you should show that event in the report of the approving authority, which means the board of directors report. Okay, you can show it there only. What we have to show there? We have to show the nature of the event. And second, the estimate of the financial effect. Okay, what are the effects on the financial statement? Okay, if you are not able to estimate the effects on the financial statement, then you can give the reason about it. Okay, now I hope you can see there are three situations. Okay, I already have completed everything, but still, we will learn from the chart. Okay, there are three situations: A, B, and C. In situation A, condition and event arose before the balance sheet date. So before the balance sheet date, both condition has occurred and event has arose. So what? So normally, as per the prudent concept, you have to make the provision for it at that financial year only. Okay, and that financial year only. Now, situation 2 or situation B. Okay, situation B, you can see the condition has arose before the balance sheet date. Condition has arose before the balance sheet date, but the event took place after the balance sheet date, but before the approval from the board of director. What does that mean? It means it is an adjusting event. So that particular event, we have to adjust in the balance sheet, in the financial statement only. I hope both situation are covered. Now coming to the third situation, which is C. Okay, so the condition and event both took place after the balance sheet date. So here you just have to report that in the approving authority, which is board of directors report. Okay, you just have to show there only. I hope, and this is a non-adjusting event. I hope you have cleared all the three situation. Okay. Now, events occurring after the balance sheet date which do not affect the financial figure stated in the financial statement. So if there are certain events which are not affecting the financial statement or the figures of the financial statement, then what? Then normally no disclosure is needed, no disclosure is needed. But if it is a significant one, then we have to require disclosure in the report of the authority, okay, which is board of directors report. I hope till here all are with me. Now there are some special cases, cases. Let's see. Dividend declared after the balance sheet date. Okay, dividend declared after the balance sheet date. So here, dividend are declared after the balance sheet date. Even if the directors know that we are going to declare, it doesn't mean that their liability has arose before the balance sheet date. It doesn't mean that. When they are declaring, here they are declaring after the balance sheet date. Here they are declaring after the balance sheet date. So it's not an adjusting event, first of all. So no liability for proposed dividend needs to be recognized. No liability for the proposed dividends needs to be recognized. Second, if you want, if it is as per the statute, if you are required, then you can disclose it in the notes. If you can disclose in the notes of the accounts. Over. Now, events indicating going concern assumption inappropriate, going concern assumption inappropriate. So if you are if there is a firm, okay, which like uh, it's not a going concern firm, okay. The events that has occurred, it's not showing a going concern firm. So at what what at that time, okay, so at that time financial statement should be prepared on liquidation basis. What does liquidation basis mean? See, account books are maintained at book value, but when there is an effect or there is an impact on going concern, whether we don't know whether the firm is a going concern or not, then you have to make the financial statements on what basis? On liquidation basis, okay. So we have to see whether the books of accounts are maintained on the liquidation basis, which is at the market value, okay. So this was the concept of accounting standard 4. I hope you have understood each and every concept. So that's it for today. Thanks for watching CS School.